Good afternoon, everyone. My name is Jonathan Oberschlake, and I would like to thank you for attending today's webinar. This is the second part of our series, Truckers and Avoiding the Hard Market. Should you have any questions throughout the presentation, feel free to put those into the chat box. And once we reach the end, we'll be sure to go through and answer any and all questions that you may have, whether it's relating to captives, which is the theme of today's presentation, or even driving to perfection and having an integrated safety model throughout your entire operation. I'll also provide my direct contact information at the end as well, so should you have questions that don't come up until afterwards, you'll have the ability to reach out directly to me as well at the end to get your questions answered. I am a risk manager here at National Risk Management Services. As an agency as a whole, we insure over 20 different clients that are all integrated into captive programs. I'm sitting alongside Tom Lucci, who is the co-founder and president of the agency, and who also personally insures about half of the clients that we have integrated into captive programs. He is an excellent resource and mentor as it relates to captive programs, and we both hope that you can find this presentation to be both beneficial and impactful for your operation. Now, when you look at the captive clients that we currently have, there is one commonality that ties all of them together, and it is the desire to truly achieve long-term low cost as it relates to their insurance. How do you achieve that? Well, the first is in driving to perfection and having an integrated safety model throughout your entire operation. What do I mean by that? The dispatcher cares just as much about the safety of the driver as the safety manager. And when you can take that integrated safety model and bring it into a captive where you can be rewarded for your safety efforts and performance, that is how you achieve long-term low cost. Since driving to perfection and having an integrated safety model is so crucial in our equation to achieve long-term low cost, I do want to provide a quick recap of what driving to perfection is. This was the theme of our first webinar in our series that we hosted a couple weeks ago, and the entire premise of driving to perfection is that if you can control the behaviors that have proven to lead to accidents, as a result, you will have a better control on your losses. Atri recently came out with an article that lists specific driving behaviors that increase the likelihood of an accident. Examples include hard brakes, overspeeds, harsh cornering. These negative driving behaviors have proven to lead to large losses. So the idea is if you can control the frequency of these behaviors from occurring, as a result, you will have fewer accidents, fewer losses, and have a better control on your premium. Now, the proof is in the pudding. Let's look at an example of one of our insureds that have embraced and truly implemented driving to perfection throughout the entirety of their operation. Before implementing driving to perfection, they had over 800,000 in total losses. As soon as they implemented the program, the frequency of the negative driving behaviors drastically decreased, and the losses went to zero. Their losses went from over 800,000 to zero. It is unmistakable and undeniable that driving to perfection works, and you will be able to control your losses when you monitor these driving behaviors. Now that we have an understanding of what driving to perfection is, let's move to the second part of our equation, captives. So when you're evaluating risk as well as insurance, there are a few ways that you can go about it. You can transfer all of the risk, which is what you do in a traditional program. You pay a guaranteed amount of premium so that the insurance company will cover any claim should it arise. However, the insurance company doesn't give any of that premium back to you, not even the investment income that they're receiving on your money. Now, the other side of the coin, you don't have to transfer any of the risk. You can do what's called self-insurance, and while that certainly means you're willing to take on risk, that has the potential for unlimited downside depending on how many claims you have, because you are on the hook for any loss that might occur throughout the policy. So what we are looking at with a captive program is the best of both worlds. The idea is that you retain the risk associated with the predictable losses, those events that you can directly control. On the other side, you will insure the losses and accidents that are unpredictable. We call those the catastrophic losses that have a large dollar amount associated with them when they occur. So let's look at insurance from the basis of two tenets. One, we've already gone over, that if you drive down losses, you drive down premium. The other is that low cost isn't achieved until you are truly able to retain the predictable and insure the unpredictable. So what exactly is a captive? A captive program, simply put, is the idea that best-in-class motor carriers come together to share in both the risk and reward of their operations. They create their own exclusive insurance group, which allows them to insulate themselves from the poor operations in the industry as well as the market. So what does that look like? Well, let's compare a captive program to a couple other insurance programs that are available. In a traditional program, you have a guaranteed cost. The premium is predetermined at the start of the policy, and you don't have to worry about any additional costs associated with it. A deductible program is similar in that the premium is predetermined based on the size of your deductible. However, a captive is different. You'll notice on this graph that most of the bars are blue. The blue represents the premium that you are giving to the insurance company that you never get back. However, on the captive, you'll notice that some of the premium is green. So the way that a captive works is that you are taking on a specified amount of risk. This is called your loss layer. This could be $50,000, it could be $100,000. It just depends on the size of operation and the amount of risk you're taking on. What happens once your loss layer is determined is we will predict and project how many losses you will have within your layer throughout the policy. This then becomes your loss fund and is actually built into your premium at the beginning of the policy. This is what gives you the opportunity to get some of your premium returned in addition to investment income. If you have less losses than what was predicted in your layer, you will get some of your premium returned to you, in addition to investment income. So in a captive, the insured is taking on a specified amount of risk. That's their loss layer. On the other hand, the insurance company is covering everything excess that layer up to the limits of the policy. So how is the premium actually calculated? Well, let's look at an example. In this example, the insured is paying $320,000 in total premium. The loss fund comprises 1/3 of that premium. It is built into the premium on the front end. So that is the total number of losses that we are predicting you will have within your loss layer. The remaining 2/3 of the premium is coming from the coverages being afforded from the insurance company, as well as the expenses being incurred as a result of writing the policy. So let's look at a best worst case scenario. Let's say during the policy you didn't have a single claim. There were no losses and there was nothing pulled from your loss fund. That means you have the potential to get every dime from your loss fund returned to you. That is money going back into your pocket. Now, the reason I say potential is because in a captive, there is always the potential for something called risk sharing. So let's take one step back and look at the opposite side of the coin. Let's say that you ended up having more losses than what was predicted at the start of the policy. What that means is that you had more losses than what your loss fund covered. So the insurance company would then bill you additional premium at the end to cover for the losses that were not accounted for. And that is called your assessment. However, there's a cap to the amount that can be charged back to you at the end of the policy. That is called the max assessment. So let's look at a worst case scenario. Let's say that you end up blowing through the entirety of your loss fund as well as the max assessment. In this case, you would pay $389,000 in total premium. Let's say you end up having more losses though than what is paid out in both your loss fund as well as the max assessment. At that point, those losses would be split between the other members within the captive with their available loss funds. That is called risk sharing. However, going back to the best case scenario, let's say nobody exceeded their max assessment and you ended up having no losses. That means you will get the entirety of your loss fund returned to you. That is where the true benefit comes from a captive. If you can control the predictable losses within your layer, you have the opportunity to get your premium returned plus investment income. Now that we know what a captive is and how it works, let's look at a couple of examples. In this example, the insured paid $600,000 in total premium. Again, the loss fund in this example takes up about a third of that total premium. At the end of the policy, the insured has $120,000 in losses, and once you account for the risk sharing, they end up getting a return of $53,000 back, in addition to interest income. Let's look at another one. The insured pays $320,000 in premium. The loss fund is $106,000. Again, the insured had less losses within their loss layer than what was in their loss fund. So they ended up getting a return on the premium in addition to investment income. However, let's look at a captive program and how it compares to other types of programs available. So in this example, you will see the captive option on the far right. On the left, you have a traditional insurance program, and then you have deductible programs in between. You have the total premium being charged at the start of the policy, and for the captive, you have the loss fund that is built into that premium right underneath. So once you account for the losses within the specified layer within each program, you get the total net cost of insurance. When you look at the total cost, this is accounting for both the premium as well as the losses, you will see that the captive program ends up saving the insured over $70,000 in this example with the captive program. It is unmistakable to see how a captive program can help a carrier achieve true long-term low costs when they can control the predictable losses, when they can control the occurrences within their loss layer. Since we now know what a captive is, on the screen you'll see a quick summary of some of the benefits as well as the reasons as to why you should consider a captive. On the right, on the other hand, you will see common misconceptions regarding captives. Now, the term captive is thrown out a lot throughout the industry. That there are several different types of captive programs, and no two captives are the same from one another. They are each built differently and each have their unique benefits. There's the idea out there that in a captive you end up paying for everyone's losses. And while there's certainly the potential for risk sharing, if you go and look at the numbers as far as the amount of risk sharing that is had compared to the total amount of premium that is paid, the total amount of loss funds that are built into these captives, the amount of risk sharing is extremely small. On the other hand, if you look at traditional insurance, you end up paying for the losses that poor operations have. In traditional insurance, you might not have any losses, but you get hit with a 20% increase at renewal for apparently no reason. Well, the reason is because the insurance company is losing money in the trucking industry because of the losses that poor operations are having. And so they give you an increase to help pay for those losses that they are having. It's also the idea that once you're in a captive, you can't get out. Going back to the idea that there are several different types of programs out there, we only work with what's called a rental captive. Now, the benefit of a rental captive is that you have the flexibility and the option to get out should you choose. Let's say the captive isn't as beneficial for you as you would have hoped. You have that flexibility to leave when you decide to. Now, a captive isn't for everyone. As I said before, if you do not have an integrated safety model and you don't have the ability to control those losses within your layer, the captive isn't for you. But if you have that integrated safety model and you want to work with best in class carriers and be rewarded for your safety performance, then a captive is for you. Again, the only way to truly achieve long-term low costs as it relates to your insurance is the combination of driving to perfection, having that integrated safety model, as well as a captive program. So what's next? If you want to take back control of your insurance and evaluate the options that are available to you, reach out. Let us know. My direct contact information is on the screen. You can also reach out directly to our offices. If the idea of a captive program interests you, reach out. We will sit down with you, go over all of the numbers, review your losses, and walk through exactly what a captive program would look like for your operation. Now, as promised earlier, we will now open the floor for questions. Should you have any, feel free to put them in the chat box, and we'll be sure to go through each one of them and answer any questions or uncertainties that you may have regarding captives or even driving to perfection and having an integrated safety model throughout your operation. So if you have a question, feel free to put it into the chat box. We will be sure to leave plenty of time. As I also mentioned earlier, should you have any questions that you don't have until after the presentation ends, we will also respond to you accordingly if you were to shoot us an email or even call us. So one question that someone has is the best way to get on the Driving to Perfection program. So the best way to get on the program is to reach out. The risk managers here at National Risk are very dedicated in working directly with carriers and going through how the program works, how you would implement it, how you would enforce it with the drivers. The entire basis is focused on daily communication from the top down. So your operations, your safety are in constant communication with the drivers as they continue to monitor the metrics that have proven to lead to losses. So if you are interested in getting on the program, I would encourage you to reach out and we can walk through what that process would look like.